Burial insurance, also called final expense insurance or pre-need insurance, ensures that your funeral expenses will be paid for without imposing a financial burden on your family. Burial insurance can also pay for other expenses such as your credit card debt, so your family won't have to pay it. These policies require answers to health questions instead of full underwriting. Depending upon how the questions are answered will determine whether coverage starts immediately or after a waiting period. If the applicant only qualifies for coverage after waiting and dies before coverage takes effect, then all premiums plus interest are returned to the owner of the policy. 1. Meet with a funeral director. Discuss the costs of a funeral and burial or research the details online. Funeral expenses vary greatly depending not only on the options you choose, but on location. They will also increase over time. A traditional burial requires a casket, headstone, burial plot and concrete liner. If you want to allow a viewing, you will also need to consider the costs of embalming. Cremation is less expensive than a traditional burial, requiring only an urn and the cost of conducting the cremation. You can choose to have your urn buried or placed in a vault, or you can direct that it be kept by family member. Green burials are becoming popular in some parts of the country. Rather than using embalming and a casket to preserve your remains, a green burial is designed to allow your body to decompose. This allows you to return to the earth and become food for plants growing nearby. 2. Consider the different payment options and what each option affords. A policy purchased with a lump sum payment will provide the full value of the policy immediately. Your beneficiary will have all the funds needed to provide the funeral and burial you want even if you die the day after paying for the policy. You may only be offered a policy with a lump sum payment if you're older. A graded benefit policy will provide a certain amount of the face value depending on how many payments you have made. For example, if you choose a policy that will be paid for in 5 years, your beneficiary will only receive all the funds after 5 years. If you die before then, your beneficiary will only receive part of the funds and will have to pay the difference or choose cheaper options. A traditional policy will provide full coverage immediately as long as you make the payments, but will be cancelled if you stop paying.